Most people think investing is complicated, charts, buzzwords, and risky bets. But real investing that actually makes sense is much simpler. It's about making smart, steady decisions that grow your money over time without chasing hype. In this video, we'll break down practical investing strategies anyone can understand, so you can build wealth with confidence instead of confusion. Let's get into it. Today we will talk about investing that actually makes sense. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding what investing really means. Investing is often misunderstood as a complicated activity reserved only for financial experts, wealthy individuals, or people who spend their days analyzing stock charts. In reality, investing is simply the process of putting your money into assets that have the potential to grow in value over time. The purpose of investing is not just to become rich overnight, but to protect your money from inflation, create financial security, and build long-term wealth. Many people make the mistake of thinking investing is gambling, but sensible. Investing is based on patience, research, discipline, and understanding how money grows gradually. The reason investing matters is because saving money alone is no longer enough in a modern economy where the cost of living constantly rises. If your money sits idle, inflation slowly reduces its purchasing power every year. Investing allows your money to work for you instead of remaining stagnant. Whether it is through stocks, real estate, mutual funds, businesses, or retirement accounts, the goal is to create additional income and future stability. Investing that actually makes sense focuses on realistic growth, manageable risks, and long-term planning instead of hype, trends, or emotional decisions. 2. The difference between smart investing and gambling. One of the biggest financial mistakes people make is confusing investing with speculation or gambling. Smart investing involves careful decision-making, analysis, diversification, and patience, while gambling relies heavily on luck and emotional reactions. For example, buying a company's stock because it has strong earnings, a good reputation, and long-term growth potential is investing. On the other hand, buying random cryptocurrencies or meme stocks simply because social media says prices will explode overnight is speculation. Investing that makes sense avoids the dangerous mindset of chasing quick profits. Many people lose money because they follow trends without understanding the risks involved. Sensible investors know that consistent growth over 10 or 20 years is far more powerful than risky short-term bets. A person who invests steadily in quality assets over time often outperforms someone constantly chasing get-rich-quick opportunities. Smart investing also includes risk management. This means never putting all your money into one investment and understanding that markets naturally rise and fall. Emotional decisions like panic selling during downturns or blindly buying during hype cycles usually lead to losses. Real investing requires discipline, patience, and logical thinking rather than emotional excitement. 3. Why long-term investing creates real wealth. Long-term investing is one of the most powerful financial strategies because it allows compound growth to work over time. Compounding means earning returns not only on your original investment, but also on the profits your investment generates. This creates a snowball effect where wealth grows faster as time passes. Many successful investors understand that time in the market is more important than trying to perfectly time the market. Trying to predict short-term movements is extremely difficult even for professionals. However, history has shown that markets generally grow over long periods despite temporary crashes and economic downturns. Investors who stay patient during difficult periods often recover and benefit from future growth. Long-term investing also reduces stress because you are not constantly monitoring prices every hour. Instead, you focus on building a portfolio designed to grow steadily over decades. For example, someone investing a fixed amount monthly into diversified index funds from a young age can accumulate substantial wealth by retirement. The earlier someone starts investing, the greater the impact of compounding. Even small amounts invested consistently can grow into significant sums over time. This approach makes investing practical and accessible for ordinary people rather than only wealthy investors. 4. Building a diversified investment portfolio. Diversification is one of the most important principles in sensible investing. It means spreading your money across different types of investments instead of relying on a single asset. The purpose of diversification is to reduce risk while still allowing growth opportunities. No investment performs well all the time, so owning different assets helps protect your portfolio during market fluctuations. A balanced portfolio may include stocks, bonds, real estate, index funds, exchange-traded funds, and cash reserves. Stocks offer growth potential while bonds provide stability and lower risk. Real estate can generate rental income and long-term appreciation, while index funds offer broad market exposure at low costs. Diversification also applies geographically because investing in international markets can reduce dependence on one country's economy. Sensible investors avoid putting all their money into one company, one industry, or one trend. Many people learned this lesson the hard way during financial crashes when entire sectors collapsed unexpectedly. A diversified portfolio does not guarantee profits, but it significantly lowers the chances of devastating losses. It creates balance between growth and protection, which is essential for long-term financial success. 5. The importance of financial education before investing. One reason many people struggle financially is because they begin investing without understanding basic financial concepts. Investing that actually makes sense starts with education. Before putting money into any asset, investors should understand concepts such as risk, tolerance, inflation, diversification, interest rates, market cycles, and asset allocation. Financial literacy helps people avoid scams, emotional decisions, and unrealistic expectations. Unfortunately, many individuals rely solely on social media influencers or viral internet advice, instead of learning foundational principles. Real investing requires understanding how markets function and why investments gain or lose value. Reading books, studying successful investors, following reliable financial sources, and learning about personal finance can dramatically improve decision-making. Education also helps investors identify fraud and misleading opportunities promising guaranteed returns. In reality, all investments involve some level of risk. Sensible investors know how to evaluate opportunities critically instead of blindly following hype. Financial education empowers people to take control of their future and make informed decisions that align with their goals. 6. Common investing mistakes people must avoid. Many investors lose money not because investing itself is flawed, but because they make avoidable mistakes. One common mistake is trying to get rich quickly. This often leads people toward risky schemes, excessive trading, or emotional investing. Another major mistake is failing to research investments properly before committing money. People sometimes invest in businesses or assets they do not understand, increasing the likelihood of poor decisions. Panic selling during market downturns is another destructive behavior. Markets naturally fluctuate, and temporary declines are part of long-term investing. Investors who panic and sell during crashes often lock in losses and miss future recoveries. Another mistake is neglecting diversification and placing too much money into a single investment. Overconfidence can also be dangerous because some investors believe they can consistently predict market movements. High fees and unnecessary trading can reduce long-term returns significantly as well. But if you like this video and would like to see more like it, please give the thumbs up, leave a comment, and click the button to subscribe.